South African retailers have seen their share prices soar in recent years as first local investors and then foreign investors bought into the South African consumer story. But with the retailers trading at lofty valuations, some disappointing trading updates at the start of the year gave way to what many are saying is a mini sell-off. The question on everybody's lips is the party over? Stanleys retail analyst Teresa Heath joins us in studio to give us the answer. And of course, we've got to start with that question. Is the party over?
Well, I think maybe for some investors it may be, because if you've held these stocks for 4 years, you can probably look to take profits at these levels and maybe switch into something that looks a little bit cheaper. And if you like to play the consumer, there are probably cheaper consumer plays, and if you can invest globally, there probably are cheaper plays. But having said that, I don't think that we can, on the back of some trading updates, which really only give you information about the sales line, call the retail sector a sell. I think the pullback is probably justified, because certainly December saw retailers sort of fly to the skies, having reached levels we thought they wouldn't get to anyway.
They just blew through all valuations, didn't they?
Exactly. So I think that this has really taken some of that froth, that end of year froth, off the market a bit. And we're really back to October, November levels, which is, so we're sitting back there, and has the story really changed? Well, I think people are starting to get a little bit more worried about the consumer outlook and consumer health, for example. And at Stanley, we're of the view that the consumer is certainly not going to collapse, but we do expect some weakness to the kind of support that the consumer's seen over the last few years. Real wage growth is slowing. You're seeing rising pressures from fuel inflation. Certainly with the rand blowing out, our fuel is going to get more expensive. And then, of course, we've got the credit servicing costs. And we're all aware that unsecured lending has grown significantly over the past few years, and that needs to be repaid over time. And so consumers are probably now looking at their wallets and thinking, I don't have as much disposable income as I had last year. Maybe it's time to tighten my belt a little bit.
Teresa, we saw Leon Kukinis in the media today talking about the impending credit bubble deflating, or obviously being wound down, and he said that there's implications there for retailers. In terms of that, do you see a sort of a worst case scenario where you see almost widespread defaults, or defaults rising substantially across the consumer story? Or is this going to be just a slowdown, as we're seeing with Abel's results in lending? They're just slowing down their lending. What are some of the implications for the retailers if that happens?
Yeah, I think we're of the view that it will be more of a slowdown than a blowout. And typically the retailers have been lending money to consumers to buy apparel and other items for quite some time. So they are relatively experienced in this game. So we expect that the bad debts will start to trend up a bit, but we're not expecting a blowout. But there will be pain to be felt, and obviously it has implications for the consumer sector as a whole. So cash retailers may be impacted. If consumers are battling to service their debts, they're not going to have the spare cash to go shopping at retailers that sell items for cash.
Let's chat about Woolworths, just to be a little bit more stock specific. I know it's done very well for you to this point, and I spoke to Herman van Velze recently, well we did, about the Woolworths proposition. Is it a stable going forward in your portfolios?
Well, we think so. I mean, when we look at the consumer market, we sort of split it into different groups, and we think the upper end of the consumer market is looking better placed than the lower and middle income consumers, and really that's because of interest rates. Interest rates at an all-time low. We don't expect them to go up in 2013, so we're kind of looking at 2014 before you see a rising rate cycle, and that really supports the typical Woolworths consumer, who tends to have secured debt, which is obviously vulnerable to interest rates. And these are the people, well, the typical Woolworths customer has got relative job security, and the cost of rising fuel doesn't impact them to the same extent as it does impact someone on a much lower income. So we're relatively comfortable with the higher kind of LSM retailers, and certainly in the trading updates we saw, the retailers that did the best are those that cater to that higher LSM group.
Just in terms of that, Teresa, obviously you have retailers that supply food and beverages and clothes. Shops like ShopRite are food retailers, essentially. I would expect that they would do quite well in a downturn because people scale down. Are some of the retailers, the clothing retailers and the furniture retailers, more susceptible to a downturn in the cycle?
Typically, I mean, food retailers tend to be more defensive than apparel and general merchandise. General merchandise is typically most discretionary. It's what you can afford to cut out first. So food retailers generally are more defensive. People still need to eat, but they may trade down. So they'll buy the third tier brand as opposed to the top brand of tomato sauce or whatever it is. They may trade into retailers' house brands, which is positive for retailers' gross margin. So it's not always a simple equation of, oh dear, consumers are trading down, that doesn't mean things will be good for us. And ShopRite is well positioned to cater for the entire market because of their 3 major supermarket brands. And they have quite a clear marketing message to each of those consumer groups. So they are quite nimble at catering for customers' needs.
How big is the foreign investor risk when it comes to the retailers? Because this is what we debated heatedly last year, is that the foreign investors have really pushed our retailers up because they're cheap relative to other emerging market retailers. I'm sure that that's the story that was tabled often. Is that a real threat? Because if we now see a sudden outflow, and obviously we're seeing pressure on the rand, are we going to see retailers collapsing from that perspective?
I think that's a big risk, because you've got to remember that you've got to have a willing buyer and a willing seller. So if the foreigners sell out, who's the willing buyer? Are local investors, who we know are underweight retail as a group, are we ready at these levels, on a say 10 to 15% pullback, ready to dive in given the consumer outlook we see? So arguably if there aren't willing buyers, then the share prices could get hit a lot harder. Having said that, I think that a lot of the foreigners continue to remain invested. They've obviously been taking profits at this stage. But certainly the feedback we get is that there aren't many other options that they're looking at right now. But it is a risk. And they've played this for the last 2 or 3 years. You know, there's this idea that foreign investors dip in and dip out. They've actually been quite loyal holders of the retailers. And at some point, portfolio management, you take profits and you invest elsewhere. So, I mean, it is a risk, and it's one that you'd watch.
Just to ask you the next logical question to follow on from Bronwyn there is how do the South African retailers compare from a valuations and an earnings growth perspective going forward?
Well, I think from a valuation perspective, we're now sitting kind of in the middle of the pack relative to emerging market retailers, having traded at a discount for quite a long time. You know, that discount gap has been closing over the last 3 years. I think the earnings growth is still viewed at positively, because generally people can bank on our retailers delivering the earning growth we expect, or there and thereabouts. You don't often get big earnings misses from our retailers that are listed. So there is a quality perception about them, and people are prepared to pay for that. So, I mean, we're not looking cheap relative to retailers, but we're kind of middle of the pack. So you can justify holding a South African retailer at this point in time, and you know, stick with it for the time being.
Another theme that is tabled often and has been ever since the Massmart Walmart transaction is when we're going to see that competition coming to the fore and impacting retailers currently in the competitive landscape.
Well, I think it probably has already impacted, but probably not for the reasons we thought. I think it's more the direct competitors of Massmart starting to get edgy and thinking, well, we better be price competitive in advance. So you have seen a little bit of price skirmishes in the market. But I think the biggest kind of misconception about the Walmart-Massmart deal is that we're going to see prices slashed. It's not really about slashing prices, it's more about saving costs in the business. They have an everyday low price strategy, but that is underpinned by an everyday low cost strategy. So if your costs in your business are lower, you can reduce prices slightly, but it also means that your shareholders get better profit. So you don't need to slash prices and slash profitability as well. It's a case of running your business more efficiently, and that's really what Walmart is bringing to Massmart. So I don't think we're going to see a massive price war. And the other point to make is that Massmart is a relatively large retailer in the South African context. So arguably they've had decent buying scale up until now.
So this is nothing new.
So
it was already cemented, their position.
So. I mean, Walmart may add an extra sort of 5 to 10% sourcing benefit, but it's not significant. In the way that I think people think. I think the cost opportunity is significant, but at the moment with Massmart's growth plans, costs are running at relatively high levels, margins are depressed. So we're not going to see those cost benefits come through because they're investing in growth.
Another company I wanted to ask you about, Teresa, is Pick n Pay. Obviously undergoing, I guess you could call it a bit of a turnaround story. Was obviously at one point South Africa's premier food retailer. What's your sort of expectation with the incoming CEO? Do you have, are there any firm plans in place that you've seen that would allay concerns around Pick n Pay's position in the market at this point?
Well, we don't actually know very much about the new CEO, but we do know that he's been spending some time in South Africa last year, and I think he has now arrived in South Africa formally. It's very difficult to tell. The man takes over the business officially at the beginning of February, so Friday I think it is, and arguably he's got his work cut out for him. And I would hope that they would probably keep him under wraps and let him get his teeth into the business rather than updating all of us on what we probably already know, and would rather he got stuck into the business and got it moving.
There's another crucial industry or another challenge facing the South African business environment at large, and that is electricity price hikes. They're obviously going to impact the retailers at a 16% increase annually, and I'm not sure how long we're going to endure, but it's for many years that we're going to see those increases. Is this something that you've started discussing with the captains of industry? How are they going to navigate this water?
Well, I mean, electricity as a percentage of their cost is quite small for retailers. It's really the lights in the buildings, and obviously if they've got manufacturing facilities or refrigeration facilities.
So it's not significant in the scheme of things?
It's not that significant for retailers. Obviously it's a cost that they look to manage, and so you are seeing efficiencies being brought in. So they're looking at more sustainable refrigeration, they're looking at lighting. So when they build a new store, they'll look at solar panels on the roof, they'll look at skylights.
So it's driving efficiency and a greener environment, actually.
Absolutely. It's more from that. I mean, the savings will be marginal relative to the entire cost base, but they are looking at it because it's not a cost that they have any control over if they leave things as they are. So they've got to try and use less energy and save that way.
Just to include the electricity in the cost side, obviously that comes through for the manufacturers, and many of these manufacturers are supplying the retailers, who sort of will have the power if and when we see big price increases coming through in food, for instance. Do the retailers try and contain that, or do they just merely pass it on when they receive it?
Well, we haven't seen retailers passing it on, because you've seen headline food inflation tracking well ahead of certainly the headline inflation that ShopRite's reporting. Woolworths typically reports a higher level of inflation, but they've got a lot more value-added products, so that is in line with what we'd expect. But the fact that ShopRite hasn't been able to push through this headline inflation suggests that they are really aware that the consumers are struggling, so they're pushing back on the manufacturers, and so that inflation is being suppressed at the moment. So retailers like inflation, they do like a level of inflation, but it does look like they're keeping the lid on it because the consumer is weak.
Just to wind it up for us then, so at this point, from the Stanleys perspective, are you taking the opportunity to buy any shares at this stage, or is it more a case of holding on to what you've got and waiting to see how things go?
Yeah, we haven't as yet used the pullback. We've been lucky enough to have owned these retailers for quite a long time, the retailers that we hold. And so a pullback, as I said, takes us back to October. We weren't adding in October, we're not adding now.
So consistency in your formulas.
Consistency in our formulas. And really we're of the view that this has probably taken a bit of the froth out the market. And so those that we hold, such as Woolworths, we're happy to sit with for the time being. And I'm not convinced that this is a big buying opportunity, which could be famous last words. But given our outlook for the consumer, it just seems as if maybe valuations had got a little bit ahead of themselves, and certainly expectations had too, because that's also another reason why stocks sell off, is people extrapolate one reported period of results and forget to think about the environment.